Hey everyone, and welcome to Course 2. This one is a little bit different than Course 1. Course 1 was a very intro beginner guide to the different types of ETFs and what an ETF is. This one's going to more talk about the risks, what are management funds, what is overlap, so you know which ones to choose that's best for you to maximize the money that you want to be making with ETF buying and trading if you're going to be a trader. So let's get started. So I want you to understand ETFs beyond the basics, that there's a growth fund, there's a dividend fund, there's international funds. This is going to say what fees are paid, when do you pay them, how much do you pay, how do you know, how do you find it, what is overlap, how do you find what is overlap, and why is overlap important. And then other hidden risks like NAV erosion, which is a little complex, and I'll kind of explain it to you in a very basic, simple terms. So why does this matter? This matters for beginners because you need to choose what ETFs are going to work best for you. You need to understand when you're starting young what ETFs are going to gain the most momentum. Is there overlap? Am I duplicating what I'm doing? Am I risk adverse? Am I, spreading my risk across different ETFs? So you understand what you're doing. So you don't just go in blind, buy two different ETFs thinking I'm in different funds, and then you're in the exact same funds and have the exact same risk when there's volatility. So that matters. All these little small details matter, and we're going to go through them. So again, we're going to cover expense ratios and fees, diversification and overlap, and other risk factors. So what is an expense ratio? Essentially, this is the management fund that manages the ETF. These are what the people above you are going to be charging you for managing the fund. They're the people that select the funds, that trade the funds, that sell the funds, and that manage your portfolio so you can make money and you can learn how to invest. So essentially, this is a percent fee. When you go to any ETF on a website, it'll have somewhere in there the expense ratio. You're going to want to choose something that's relatively small because it does add up over time, especially if it's like a 0.5% ratio. You're going to want to choose something that's like a 0.03% ratio. A lot of ETFs are that way. Usually the passive ETFs are that way. The actively managed ETFs are going to be higher ratios and take more of your money over the course of 30 years. So it does impact your returns, and you think it might be small because it could be like $5 to $15 for every 10,000, but that adds up over the course of 30 years when it could be reinvested. So it's a benefit to have a lower expense ratio. So let's just see an impact. Imagine if your expense ratio is 0.03, that's only $3 for every 10,000 you're investing. But if you're in a 0.5 expense ratio, that's $50 for every $10,000 that you're invested in. Let's say it adds up. You have a few $1,000,000. Of course, that number is going to be much larger, and it does impact how much money you will have in the future when you're going to retire. So ETF overlap. You can use an ETF overlap tracker and website and just type in the two ETFs, and it'll show you precisely how much overlap they have with nice circle graphs, explanation of the funds that they're both in, how many funds they're both in that are the same, and give you a weighted score. I have a video on that, and there will be a link of an ETF overlap tracker in the bio or the description, so please take a look. This is really important because you're not spreading your risk. If you're in two of the exact same funds, why? Just choose one, because if they're in the exact same funds, no matter where there is volatility in the market, they're both going to go down the exact same percentage. So it's very important to check fund overlap so you're diversified if that's your goal. How to avoid overlap? Simple. Check what funds they're in. Check the sectors that they're in. Check their top 10 holdings. Check the weight. These are all things that we can check on an ETF overlap. It'll show you what sectors they're in, and it'll show you what top 10 holdings each have. It'll show you the percent weight each fund has, so then give you a score of like say 58% overlap. And then you're going to want to do that before you select and solidify your choices on what ETFs you're going to be in. Fund size, liquidity, and trading costs. This is important. The larger ETFs are stable. Let's just say QQQ, for example, it's $600 compared to an ETF that's like, say, $25. Typically, those are more dividend funds. But larger funds usually have more stability because they have a lot more money. They've been trading for a lot longer time, and they're in companies that have stability in the sense of they're not expected to just crash all of a sudden. So it's important that you do select a larger ETF, let's just say like VTI, which tracks an entire market, because if something goes down in that market, there's still hundreds of others or even thousands of other stocks that are in that market. There's also higher trading volume. Let's just say VTI has 50 billion, for example, in trading value. And they trade in 12 billion a day. That, for example, is good because they are trusted and they have a lot more trading volume. Lower trading volume is more risky because those companies are probably less likely to be solidified and in the market every day. So risk versus volatility. Volatility is basically the normal short-term price fluctuation, like QQQ, for example, is a tech stock. So if one company doesn't perform well that day, there's going to be short-term volatility. And risk is more permanent. Risk is, what is the risk of investing? You could lose it all. Or, so the risk is more long-term, whereas volatility is more short-term. Nav erosion is a little confusing, but I want you to imagine you have a toy box and you have a bunch of toys in it. And the full value of the toys, all of them combined, is basically the NAV, the net asset value of all the toys combined. Let's just say you want to play with some of the toys. You want your Pokemon toy, you want your Pikachu, you want your Digimon. You take a toy out, but you don't ever replace it. Over time, the value of the box diminishes. And this is a good example from usually dividend funds. If they aren't paying you a dividend, but the net value of all the stocks combined in that are decreasing over time, you're basically getting your money back or losing money because the value of your actual stocks are less. And so it's important to understand that. That's my best example, is that a toy box value decreases over time without being replenished. So the causes are when there's a high expense ratio, because obviously they're taking money from you, when they're frequently internally trading, when they are using leverage, and examples would be a leverage ETF resets daily and can lose value over time even if the market remains flat. So I want you to understand NAV erosion. It's quite confusing, but it's essentially when your value of the stock is diminishing without increasing in value. So an active ETF usually is more of an expense ratio. They charge more to manage it because they're actively trading and they're actively choosing stuff that's going to beat a passive market. Passive markets are like an index. It tracks the index, VTI. It tracks the S&P. You want to track the NASDAQ. You want to buy an ETF that tracks the Dow. Those are passive. They're just in the market, is doing what it does. Active is they selectively choose certain stocks that make up the ETF and constantly switch and choose them depending on how the market performs. So essentially, I want you to understand from this course that there's hidden risk involved with all of the expense ratios, with fees that are being charged, how is it being managed, is there fund overlap. Research will help you in this. So I really appreciate you all watching this course. If you want to watch course 1, that is also in my feed. So just check out my channel. Have a great day, everyone.